One of the important things in stocks is that the stock does not know that you own it. You have all these feelings about it, and you remember what you paid, you remember who told you about it, all these little things, and it doesn't give a damn. It just sits there, and a stock at 50, somebody's paid 100, they feel terrible. Somebody else paid 10, they feel wonderful. All these feelings, and it has no impact whatsoever. And so it's.
Hello and welcome back to the video. You are hearing a solid piece of advice regarding the stocks by none other than Oracle of Omaha, Warren Buffett himself. The guy is the most successful investor of this century and has built up his $100 billion empires of wealth from nothing but investing in stocks. Who could know investing better than him? He has explained the stocks many times, but in this video, we will focus solely on what he thinks and advises about selling your stocks. If you're into the stock market, you must know that buying and selling stocks is an art that will either break or make you. The only essence of this art is time. Time dictates your decisions, and on this, in turn, affects your success percentage. Many people lose their fortunes in the trading market as they do not act in the instant and then repent later. Buffett, having decades of experience in selling stocks under his belt, knows this valuable concept and has fully consumed it to his advantage throughout the years. He has a very distinctive approach to the topic, and for him, there are only 3 reasons to sell a stock. If there's a reason other than these 3, at least Buffett ignores it. Number 1, economic plunge. When a business starts to go downhill and is unable to recover, Buffett thinks it's time to withdraw before it's too late. But the important thing is to keep a very strict eye on the economic characteristics of the business you have invested in. You shouldn't just sell based on some bad news or sell due to a bad trading day. After a downfall, if even after all the means have been exhausted and the business still can't perform better, or it's overtaken by a better company, only then is it time to sell. The second one should be seen beforehand to avoid huge losses, and this requires focusing on not only the company you're interested in, but also in its competitors. He lives by the rule, if business does well, the stock eventually follows. And if that's not the case, he likes to forsake the business. To explain this concept better, let us give an example of International Business Machines Corporation, or simply IBM. It's the company of computers that we've all had as a child. Buffett bet much of his fortune on IBM and started buying in 2011. It was when IBM was progressing by leaps and bounds. But over the years, many competitors joined the race and the stocks began to plummet. The company started to go out of business. Warren saw this before things got out of hand and started selling. He announced that he had fully exited IBM in 2018. This saved him, and in return, Berkshire, from a humongous loss, and surprisingly over the course of a decade, the return rate for this particular stock was a whopping 48%, in accordance with their initial investment. Number 2, trade in for something better. Buffett didn't have enough money growing up, and he had to trade to get new things. This taught him to trade, and it was one of the reasons for his success, because he became so successful in trading that he didn't buy anything again. He says the same is true for stocks as well. If you have stocks in one company, let's say X, and then you see a better company, let's say Y, you should compare the returns of both. If B gives a return, you should sell all your stocks in the first company and then invest what you've obtained in the second company without giving it a second thought. While explaining how he personally shifts his investments from one company to another, he added in an interview, "We generally sell what we would sell if we needed the money for something else. But that has not been the problem for the last 10 or 15 years. 40 years ago, my sales were all because I found something that I liked even better. I hated to sell what I sold, but I also hated to borrow money. So I'd reluctantly sell something that I thought was terribly cheap to buy something even cheaper." Remember him selling IBM cheap? After selling his stake at IBM, reinvested everything into Apple, just as he advised, and this made a huge impact on the whole tech industry. Little did he know that this Apple stock later would become his most valuable asset by late 2019. If you are enjoying these ideas, kindly subscribe so we can keep bringing videos like this for you.
We generally sell, we would sell if we needed money for something else, but that has not been the problem in the last 10 or 15 years. That 40 years ago,
my sales were all because I found something that I liked even better. I hated to sell what I sold, but I also didn't want to borrow money. So I would reluctantly sell something that I thought was terribly cheap to buy something that was even cheaper. Those were the times when I had more ideas than money. Now I've got more money than ideas, and that's a different equation. So now we sell really when we think that when we're reevaluating the economic characteristics of the business. In other words, if you take don't want to name names, but take a stock we've sold of some sort. We probably had one view of the long-term competitive advantage of the company at the time we bought it, and we may have modified that. That doesn't mean we think that the company is going into some disastrous period or anything remotely like that. We think McDonald's has a fine future. We think Disney has a fine future, and there are others. But we probably don't think that their competitive advantage is as strong as we might have thought, as we thought it was when we initially made the decision. That may mean that we were wrong when we made the decision originally. It may mean that we're wrong now, and that their strengths are every bit as what they were before. But for one reason or another, we think that the strengths may have been eroded to some degree. A classic case on that would be the newspaper industry generally.
Number 3. When a stock is skyrocketing. When we see our stocks and holdings in a company's boom, we are nothing but delighted, and that dopamine rush blinds us. We become greedy, and instead of selling and making out the most of our precious investments, we hope for even more. Buffett explains the fact that it's actually not how the markets work. Unless you plan on holding on to a stock for a lifetime, you should sell it even if the profit is not as much as you expected. The reason is simple. When a stock rises, it's bound to fall soon, if not later. This is one of those mistakes that many young traders make today, and this always costs them way more than they anticipate. One of his very famous quotes highlights this point even more. Never test the depth of a river with both feet. If the investment expands too much. The last principle in the rulebook, Buffett is told by him many times, never put all your eggs in one basket. This means that never invest all your earnings in one place. This single investment may seem like a great idea at first, but trust me, it's not. The chances of huge profits from a single stock may be more, but the risk associated with the loss easily outweighs the pros. Buffett holds millions of stocks, but never in his life has he limited his stocks to one company. And that is one of the main reasons why he has outperformed all other major investors that were once competing with him. His company Berkshire based stocks on holdings in at least 5 major and numerous minor companies. He says to break up a single investment and scatter it so you always have a backup plan in case any single company goes crashing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. Buffett's insight according to today's market. The best stock picker and investors' far-reaching advance is evident to be true if we take a glance at the recent market crash of 2022. The new government policies introduced took a toll on the economy, and the stock market also took a hit. Most of the loss was contributed by the S&P 500, which has more than doubled and was the main investment of most people since the start of 2022. It was on a continuous rise over the past months, but of course, this could not continue forever, and the stock tumbled, reaching the depths and taking millions, if not billions, with it. Had the people been paid to heed to Buffett's advice, the damage could have been at least minimized. So, this brings us to the end of the video. Kindly like, share, and subscribe if you liked the video. We'll keep bringing more videos like this, so stay tuned. See you in the next video.